All right, in this video, we are going to go through the Modified Endowment Contract, or MEC. What is it and how do we prevent it? And if it does happen, can we reverse it, as a quick little side note? So first and foremost, what is a Modified Endowment Contract, or a MEC? Well, it is a special type of life insurance policy that is really classified somewhat as an investment in respect to the cash value. If you have familiarity around cash value life insurance, when we talk about the cash value, what are some core benefits? If it's all set up properly and we do everything right, it is a safe, liquid, tax-free area to position money. Now, when it no longer becomes tax-free, one example would be a modified endowment contract. So any cash value life insurance policy can become classified as a MEC. If it does, there's some things we have to deal with here. So Modified Endowment Contract, or MEC, is first and foremost, when it comes to the actual life insurance policy, the death benefit is still paid out 100% income tax-free. I should write that above. And why I always state that is because when it comes to life insurance policies, we often hear tax-free. Tax-free with the cash value if I do everything right, which is what I have access to, and then tax-free with the death benefit. When I die, money is left tax-free to my heirs or beneficiaries, which is true. However, if I have a high net worth, death benefit proceeds are not automatically exempt from estate taxes. Good to be aware of that. If I have a high net worth, I want to establish some type of trust or have my planning set up properly where I can still leave money in the most efficient manner. Now, regardless of a life insurance policy being a MEC or not, the death benefit proceeds are treated the same in the sense that they are paid out income tax-free. Now, when it comes to the cash value, here's what I've got to be aware of, because this is where it's different. One, payments are still made with after-tax dollars. So just like a traditional non-MEC life insurance policy, when I make a payment, it is made with after-tax dollars. This would be similar to that of a Roth account in the sense that I am not able to deduct my premium payments. Money I've paid into a policy is paid with after-tax dollars, i.e. money I've already paid income tax on. Now, the growth, like a non-MEC policy, is technically tax deferred, meaning if I did not touch my cash value, if I have a modified endowment contract and I just keep slugging money into cash value, I don't touch it, and I die, the death benefit's still paid out income tax free. Meaning, if I'm just stashing cash away and I have no need, no desire to touch the cash value whatsoever, well, that could be one situation where potentially a MEC might be okay. It might work. A MEC does not mean it's always a bad thing. It's good to see it up front depending on one situation. However, the growth is tax deferred, meaning as I accumulate a gain on the policy, I'm not automatically going to pay taxes on that. Here's the thing though, when I access the money, so if I access money on a non-MEC policy, if I'm taking loans, if I'm not withdrawing more than my cost basis or loaning beyond my cost basis with a non-MEC, I do not have to deal with taxes. However, with a MEC, I have to deal with taxes. Specifically, what happens, two things to be aware of. One, whether I take a policy withdrawal or a policy loan, in respect to the gains, I have to deal with ordinary income tax. So not capital gains tax or anything like that. If I'm in a 30% tax bracket and I've got a $100,000 gain on a life insurance policy, I pull out $100,000. What's going to happen is I will have to pay ordinary income tax on that $100,000. Gains only, cost basis is not taxed with a MEC. Now, if I touch the money prior to age 59 and a half, I have to deal with an additional 10% penalty tax. Not fun at all. So in short, if I am purchasing a cash value life insurance policy for cash accumulation, I have a desire to borrow and repay, I want to use the policy over time, a modified endowment contract will likely ruin a lot of my plans or having the ability to use it. Because frankly, once I trigger a MEC, I have to deal with taxes on the gains. And how it works is any money I pay into the policy, if I've paid in $100,000 and my cash value is $150,000, any loans or withdrawals I take, specifically with a MEC, I have to pay taxes on the gains first. Where typically we think of, hey, if I paid $100,000 into any type of account and I have $150,000 in cash value, typically I can withdraw up to my cost basis, no taxes, and then I'm taxed on the rest. With a MEC, it is the reverse, meaning anything I pay in, when I start to pull money out, I'm going to pay income tax on the gains first. In short, we don't want it. It's bad when it comes to cash value accumulation. It ruins a lot of our plans. So, how do I prevent it? Well, every policy has what is called a MEC limit, which is exactly what it sounds like. It is a limit that determines the maximum amount of money I can pay into a life insurance policy per year without triggering a modified endowment contract, meaning still have the IRS classify the policy as life insurance, not a pure taxable investment. So, let's get into it. With a MEC limit, it's exactly what it sounds like. It is a number that determines how much money I can pay into the policy. So the question often is, what is the limit? What's the limit? Question mark. So the nice thing is we can actually set that limit wherever we want. What you'll find is that it has a direct relationship to an individual's age and total death benefit on a life insurance policy. When I say total death benefit, this would consist of the whole life death benefit and any term riders attached to the policy as well. So, an example here would be a 50-year-old male with a $1 million death benefit would have approximately, this is almost spot on, $50,000 MEC limit. Gender does play a role in this as well, but the primary drivers are age and death benefit. So typically, how we'll set this policy up is if I wanted the ability to pay in $50,000 per year, we're going to set the death benefit at the minimum amount needed. This keeps my costs as low as possible to obtain that $50,000 MEC limit. If I wanted the ability to pay in $100,000 per year and I'm a 50-year-old male, that's going to be approximately a $2 million death benefit. You will see it all be relative, and the nice thing is about the MEC limit is it's typically very consistent from company to company because it is an IRS limit, not an insurance company limit. But age and death benefit, think of it this way, that is the measuring stick that the IRS uses to determine if a life insurance policy will be viewed as life insurance in their eyes or a pure taxable investment. Now, one last thing on the limit. It is a cumulative limit. And what that means is any unused MEC space will roll over year to year. For example, if I take out a policy with a $50,000 MEC limit and I pay in $10,000, that means I could have paid in another $40,000, but I only paid in 10 when 50 was my cap. So what happens is year 2, the MEC limit resets at $50,000. Each year it resets, plus any unused MEC space from the prior years actually, so it's cumulative as time passes. But staying on this example, that additional $40,000 I did not pay into the policy in year 1 rolls over. So year 2, my MEC limit resets at $50,000 plus an additional $40,000 that I did not pay the prior year, so I can make a total payment of $90,000 into the policy in year 2 if I want to. And that'll continue on. So any years that I do not max out my limit, any unused MEC space does roll over year to year. Kind of like those old cell phone plans with the rollover minutes. If you remember those commercials, only the rollover minutes, the rollover MEC space here continues to roll over. The one thing that needs to be added here is when we start a policy, Wherever I set my MEC limit, that's it. That's what it is for the first 7 years. Another name for the MEC test is the 7-pay premium test, meaning it's really the first 7 years of a life insurance policy where, again, vice grips, call it from the IRS, are very, very tight life insurance policies. After the first 7 years, that MEC limit will reset, guess based off what? Age, death benefit, also how much cash value I have in the policy at that time. But it's important to track the MEC limit and make sure that if I have a desire to pay into a policy for a long period of time, I want to make sure that that policy does not MEC at any point in time based off of the company's present illustration, which is what any agent can project. But it is very, very critical because we've seen a lot of people get into trouble like this. When I say trouble, they have to reduce their payments or they run into MECs, is looking at a conservative dividend rate or no dividend. Look at the guarantees. If I see my policy MECing based on a projection in a conservative dividend environment, that means that that death benefit is not appreciating at a fast enough rate. If you're very advanced or seasoned in the insurance industry, you know what I'm talking about. If not, we do have info on our agent training program. Feel free to reach out anytime about that. So what happens if I trigger a MEC? What happens? Well, it is true that once a policy is a MEC, it's always a MEC, unless I cash it out, cancel it, and use the funds to fund a new policy or use them for whatever. However, when I first initiate it or when I first trigger a MEC, so let's say I pay money into a policy, I've got a MEC. Am I automatically done forever? No. Typically, you have a 30-day window to reverse it. Meaning if I trigger a modified endowment contract, typically the next day I'm notified, the insurance company will notify the policyholder, also the agent, saying, hey, critical alert here, you triggered a modified endowment contract. You need to take action. So the action here is typically very simple. One company actually comes to mind here that if you trigger a MEC, the policyholder, the owner, must notify the company, and this can be through an email, stating that the MEC was an accident. Say I just added too much money by accident. That's happened. I can count probably on one hand the number of times it happened, maybe 6 or 7, but it happens sometimes. We pay in more money. I thought I had more MEC space, or I ran into a good problem. I try and pour funds in. Triggered a MEC. Hey, no problem. I reach out saying, hey, you accidentally triggered a MEC. All I need from you is an email stating that the MEC was an accident and you'd like to reverse it. What will happen then is the amount that you went over the MEC limit for the year, the insurance company will refund the difference. That is a nice way to prevent a MEC if it is caught within that 30-day window. That's really the key there, if I can catch it initially. Now, what happens if you see an illustration where you're paying in X amount of dollars and you're told, hey, based off of this design or this illustration, in year 25, you're going to MEC out. Your policy is going to trigger a modified endowment contract if you keep making payments. So you really like the design and that's the one thing that's just holding you back. Well, the question to ask is, do you want to fund the policy at the max or whatever that illustration is for 25 years? If no, then you're okay because you can stop funding much earlier than that in most situations. The other thing is, let's say you were not aware that you were going to run into a MEC in year 25 and you're paying money in and year 25 comes. Well, what would happen at that point in time? The same warning would pop up. You'd basically be forced to pay in a lower amount than what was originally anticipated in order to prevent a modified endowment contract from occurring. Point is, it's very easy to prevent or reverse. Most insurance carriers, especially the larger ones, are equipped. They've got great monitoring around this and they're going to notify the agent if it happens, and typically before it even happens, saying, hold up, we see this payment coming in that is going to trigger a MEC. Does the client definitely want this? Because they know people are typically unhappy when it comes to a modified endowment contract. Know this was a lot of information, went into some detail, especially on the last piece there. If you have any questions, feel free to reach out anytime. If you're a policyholder, I should say, Interested in a cash value policy, reach out anytime. We'd love to work with you. If you're an agent, feel free to reach out as well. We do have a training program that really goes into the nitty-gritty as far as the MEC laws are concerned and a whole lot more. As always, I do hope that this helps, and we'll talk to you soon. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.